How you going, guys? Can you all hear me?
Yeah, I can hear you.
That's good. Okay, let the show go on. FXTG educational webinar. Welcome to the world of Forex with Roczniak. That's myself. General advice disclaimer. This presentation is aimed to be educational in nature and should not be solely relied upon as recommendation and invitation to enter into a particular transaction or to apply in particular trading strategy. You should not engage in trading unless you understand the nature of the relevant markets, the rules and application of these rules to the strategy or strategies you are trading, the products and the full extent of your exposure to risk of financial loss. If you are in any doubt, you should seek professional advice. Number one, the advice contained in our site has been prepared without taking account of the objectives, financial situation or needs of any particular client. And two, because of that, the client should, before acting on the advice, consider the appropriateness of the advice having regard to the client objectives, financial situation and needs. And three, you should know that FXTG clients are required to read all product disclosure statements. There's 3 in total. Welcome. Why should you listen to me? I'm a highly regarded Forex trader, trading coach, and Forex fund manager living in Australia. I have over 15 years experience trading the financial market, including Forex, CFDs, stocks, and binary options. My hands-on experience helped me to utilize simple and effective strategies for my clients and investors. My passion for trading in the market had become my career, and I can also help you become a successful Forex trader. Lesson 4, how to trade using Stochastic Indicator by Roczniak. Definition of stochastic. The stochastic is a mathematical tool that can be used to gain probabilistic estimation of when the price of the market has moved too far and it's due to change direction. Stochastic indicator. Stochastic indicator is displayed as 2 lines. First line is called the K line and is displayed as a solid line. And the second line is called the percent D line and is displayed as a dotted line or broken line. The K percentage line represents the rate of change of price action. It's actually the indicator itself, and the D line is a moving average of the K line indicator. It is also called the trigger line. How to trade using the stochastic indicator oscillator. There's 3 ways to trade using this indicator. First way to trade, you buy when the K rises from an oversold position into the neutral zone and sell when the K falls from the overbought area into the neutral zone. An example being, as you can see here, below 20 is oversold and above the 80 is overbought. So basically, when the line crosses the 80 line, you sell, and the line crosses the 20, go above, that's a buy. That's going by the K line here, the solid line here. And the neutral zone is basically the center. You can choose either to have 80 and 20. Some people use 75 and 25, or even 10 and 90. That's up to your own discretion. I tend to like to set it on 80 and 20. Second way to trade, buy when the indicator K line rises from below to the above the trigger line D, and sell when the indicator line K falls below the D line. Now this type of signal is most effective when the crossover occurs in the neutral zone. In other words, it's similar to the other one, but this, when it happens, so you can rebuy to uptrend from the neutral zone. So it's crossover. As you can see here, the solid line crosses over the dotted line, And same thing when you overbought. So let's just say if you got into here, you can go back in again at this point here where the solid line crosses over the broken line with the arrow showing here. Okay. Now, the third way to trade, the bullish and bearish divergence alert the trader to a change of the market direction. Divergences occur when successive peaks and lows in the price data move in the opposite direction to the corresponding peaks and troughs in the indicator. Divergences produce some of the best signals on this indicator. Bullish divergence means market should rise, and bearish suggests the market should fall. So example being here, there's the bullish divergence. As you can see, it's the bottom trough shows up another bottom, and on the stochastic is the opposite direction. So here is down, and here it's up. That's a very, very strong signal for that the market will run away bullish for a buy order. And as you can see, again, in the bullish, it is done the opposite direction. So it's here, it's higher, but the divergence on the stochastic is lower. So it's done the opposite. Therefore, it's a very strong signal for the market to actually move back down. It's the very opposite of, obviously, the bullish. Down in here and up in here. Now, is there any questions?
What time frame should you use this stochastic as a guide? In a 15-minute or a 1 hour?
Okay, you can actually use it in any time frame. All depends what you're trading. I mean, if you're trading 15 minutes, use it on 15 minutes. If you're trading in 1 hour, use it for 1 hour. But you can also use that to determine, let's just say if you do it on 1 hour and then you go back to a 15-minute chart, it will show you a better entry on that level. So if you were to mark, let's just say in here, this is where the bullish divergence happened in here. On this one, where the market just ran off to the top, you can then go back down to a 15-minute chart. I might have to show you where the entry would have been on that one. Just move the chart across. Actually, you probably won't be able to see it on here. It's best usually to use it on a chart that you actually are trading yourself. This probably won't be shown because it's actually drawn on a bigger chart. It's not a not shown as a trend line. It's actually shown as a. Oh, there we go. That was right in here, and that's where the market. You would have seen the entry of the market actually just exploding in that sense on the 15-minute chart. So basically, I wouldn't even compare it into from one time frame to another. I would just look out for how the stochastic is behaving on the different time frames. As you can see here, there was a higher low, lower low, and in here, obviously, those lines were drawn obviously on a 1 hour. So it's not a good example to show it on a different time frame because it sort of doesn't make sense because you're thinking, well, why didn't I use this one or why didn't I use this one? I mean, even in that respect, yes, I could have used, let's just say, from here to here, because if you correspond this one with the bottom of this one and in here, it's a higher high of the bottom, and this is a lower low of the bottom. So in a sense, you could have, looking at the 15-minute chart, go right from here to here for divergence, and then again you could have taken from here to here. So really you got to look at each chart that you're trading. There's no point of drawing it on 1 hour and then going back to a 15 minutes and then trying to find it, or where is this? It's been minutes and minutes and minutes, because obviously on a 15-minute chart, each buy is worth 15 minutes, whether in 1 hour, each buy is worth an hour. Therefore, there's going to be a huge distance by the time you'll be able to catch where that line is. So it's best to, obviously, if you're trading 15, look for the opportunities on that 15, like in here. At the bottom, it crossed over, and you could have entered the trade basically when the green line shown in here. Basically, your entry would have been right here, right at the bottom of the whole of the trade, and you could have taken it all the way up. You could have, well, if you wanted to, you could have waited till the market came back to the 80 line, and you would have exited in here. Then to follow that through, because the market turned around, as it said on the other example of going back in the neutral zone, because neutral zone is in between the 20 and the 80, you could have came back into the trade right in here, and then again got back out right in here. So there would have been 2 trades you could have successfully traded in here. Does that make sense?
Yeah.
In the, I suppose, in the other direction in here, you've got, trying to find something else here to show. Let me go back towards in here. Again, you can see the same thing in here happening, where you've got the divergence happening slightly in here, and it's lower.
Okay.
And then same thing up the top in here. And you could have taken that basically all the way down. Does that make sense?
Yeah, it does. Interesting.
Yeah. It's I suppose.
But it's just an indicator which is going. I mean.
Sorry, could you just speak up a little bit?
I'm saying it's just the indicator to watch it.
Look, a lot of people. You also, what another thing you got to do, you got to sort of.
People are trading on that?
Sorry.
Do people trade only on the stochastic?
Look, I wouldn't probably trade with one indicator. Maybe I would get a something to confirm it, like an RSI, relative strength indicator, which you can also put on to give you confirmation, to combine your entry. I might have to just change something in here with the RSI. What I would want to do, I want to put on another level, because RSI indicator, you usually enter or exit on a 50 line. So I'll add that 50 line, which is there. So in a sense, it also tells you in here, looking at this divergence in here, you can either enter because it crossed over the 80 line to go to a sell, and you can also confirm it with the RSI indicator to cross over the 50 line, and that will give you a better understanding that the market has actually confirmed itself twice. So you've got divergence, you've got the stochastic, and you've got the RSI saying it's definitely going down, and therefore you can take this whole trade down. And also the RSI will probably keep you out of trouble too, because if you wanted to quickly just jump out of here, which means you're only taking this little trade here, and you can see that the RSI has not moved above the 50 yet, therefore maybe it's not the time to exit yet. You could actually withhold this whole trade till it started to actually go up quite suddenly, like you can see right about there, where the stochastic actually started moving up, even though there's a down candle, and it just keeps on going, and it's starting to trace up. So you think, okay, maybe it is the time to actually get out, because now the RSI is about to confirm. So you could actually get out from the trade, virtually right at the bottom of the whole execution from the sell order. So pretty getting the maximum out of the whole trade itself. Does that make sense?
Yes and no. Yes and no. I was just thinking, how can one see at that point on the stochastic or at the bottom point confirmed by the RSI? That bottom point on the 10th of December.
Look, basic rules for the RSI is if the RSI crosses below the 50, it's usually a sell. If it goes above, as in here, it's usually a buy.
Okay.
Okay, so you're confirming the RSI of a buy right here when it crossed over that 50 line that we see here. And you're also confirming it with the stochastic right here to go along with this trade. And it's like saying, okay, now this stochastic, as you can see, actually gone down. So you're thinking, okay, I can either exit up here because it's crossing over the 80, so you could exit it here, or you wanted to confirm with the RSI. RSI hasn't crossed over the 50 yet. Therefore, you would not exit this trade, or you could have exited right here and then get back on it as soon as the stochastic turned back up, because the RSI is still above the 50, therefore it's still in a buy position. And you could have, like I said, re-entered at this point and then taken up really high to the top.
Okay.
So you can either have one trade because you didn't get out because the RSI didn't cross, or two trades, having one up here and then getting out, and then waiting for the stochastic confirmation again, obviously confirming with the RSI, and you could have gone back into the trade here and then traded up again.
Okay.
Okay?
Yep.
Look, a lot of people use a lot of indicators. The more indicators you use, probably the more you're going to be waiting for confirmation, and by then it's going to run away with you. So I would say myself, RSI, stochastic, maybe even using divergence is best way to look for a trade entry. And you just confirm it basically with the stochastic and the RSI for that matter. I mean, I myself personally, I might use one or the other sometimes, but I'm more of a technical trader where I use support resistant lines and trend lines to trade. Everyone's got a different way of trading. Everyone's got a different style of trading, and everyone uses different indicators to trade. It's all up to either understanding it and or learning it one way and sticking to it. Does that make sense?
Yes, it does.
Not sure more what I can...
I mean, I've always had this stochastic, but I've never really taken cognizance, you know, it's there. Now I must use it as a tool to help me make the decision.
Actually, that's basically what it is. It's just an extra tool that, see, all the indicators usually, they are either too slow or too fast. They are lagging or just way too much ahead. That's why it's good to use something hand in hand, whether you use an RSI and a stochastic and maybe a trend line. You know, you can, let's just say, if you were going to catch this, you were going to draw a trend line on the chart to know how far, oops, I don't have the extension. There we go. Okay, so maybe instead of going in actually up the top, being very, I suppose, jumping into the equation very quickly, like you would have, if you wanted to confirm with the RSI, yes, this is pointing down. The RSI still haven't gone past the 50 line, and now you're seeing the stochastic at the bottom. You're thinking, well, hang on, here it's telling me sell, here it's at the bottom. You know, what do I do? Do I get in, or do I wait for the stochastic to rebound before I go back into the trade? Therefore, using something like a trend line to show you, yes, we've broken through. I wouldn't have entered it somewhere in here. I would actually enter it right here, where it broke the trend. And it's confirming me, I would say, if I was used to use the RSI, this is the first point where the RSI is actually showing me that it is below 50. So the entry for the down would be right here, right from this bar. And I would just follow it through till it keeps on going, and maybe would have got me out somewhere around here where I can start seeing the RSI rising to the 50 level, and obviously the stochastic being up the top, which also could also tell me if the stochastic is up the top, there's a likely chance that it's actually going to come back down again.
Okay.
Okay, so if you were to obviously start it at this point, you would have put your stop loss, let's just say, either above here or maybe where there's a bit of support along here where you got 1, 2, there's 3, there's a 4, 5 bars in here. You could put this stop loss in here and you could have actually withstood this slight rise and take it all the way down.
Okay.
And as soon as you got this rise again in here and starts going down, and this is where you can draw another trend line, obviously going in the opposite direction and so forth, and you could have stayed in this trade until it actually crosses over this trend line in here.
Okay.
So basically you could have came into the trade somewhere along here and come out on the close of this one, which they would have given you using the 15-minute chart. Let's just say worst case scenario, you actually entered it from here at a lower point and exited in here. You got 26 pips, which is, not too bad.
Yeah.
Although I got to say, I wouldn't probably be trading the last part of the market in here because this is the American Open is in here. This is about the lunchtime. Yes, the market moved. I usually would have been out of the trade way beforehand. For me, like I keep on repeating myself, I usually trade during the London Open till about the US lunchtime.
Okay.
Okay, because this is obviously the more of the sleepier period of the New York Open, New York trading hours, and this is here obviously the Aussie time. Okay, this line here is a break line of the beginning of the day and end of the day. Here in Australia, like in Melbourne, for an example, the first bar here is actually at 9 o'clock in the morning. So it's 9 o'clock in the morning till 9 o'clock in the morning. Okay. Looking at the platform time, that's actually like midnight to midnight. And if you guys not sure how to draw or get those start of the day and end of the day, basically when you open up a chart, your chart shows, it's shown more likely like this. Well, this is just confusing. You don't know whether it's the start of the day or was the end of the day. So what I do, I right click on the chart, go to properties, I get rid of the grid, and I show period separators. And there you go. A lot cleaner. And if you're studying the charts, different currencies, whether it's the Aussie or maybe the Euro, you can start seeing some resemblance of what's happening in the market. As in, today's probably a bit of not a good example of a day, but you can see what happens during the UK Opens. The market usually goes one way, and in the US market, usually it corrects itself. Let me just get rid of this. This is a perfect example here. Aussie market, UK market kicks in somewhere around in here, breaks, goes for a nice trend, uptrend, gets up to the American New York Open, and does the opposite thing. You can go back again in here. Here, obviously, the UK market open went down. When it comes down to the American market, went back up. Okay. You can see those clues usually. Once you start studying some different currencies, you'll start noticing. Yes, in some cases it's just going to be down, whatever. Just being bad news after bad news, but you can start seeing, UK up, American down. And if you're using support resistance lines as well with your trading, that will give you heaps more clear picture as well. See, that's why I don't trade every currency. There's no point. I rather stick to the majors, being Euro USD, British Pound USD, Aussie USD, USD Yen, and maybe gold. Okay.
Yeah.
Obviously, your spreads are lower on those charts. There's more liquidity. There's more movement. And obviously something like the London Open, where there's a humongous volume, the majors always move. They don't really gap. They might gap at the end of the day also, but that's about on the open of a day. But that's about it. They don't gap throughout the middle of the day like some other currencies will. Is there any other questions?
No, clear to me.
Sorry?
I said it's clear to me.
It's clear to you. That's good to hear. Okay. This is, as I'm going to say, this is sort of like more of the basics of the indicators. I mean, as I go through each webinar, I'll introduce another indicator, and then I'll get into more of the nitty-gritty of actually putting something together. This is sort of more about understanding each indicator and what to look for in each indicator. So, like I previously said, don't worry about looking at 1 hour and then trying to find it back into 15 minutes. Because this is what the stochastic or the RSI is doing. It's actually letting you find the entry points and confirmation on the indicators at that time frame you're looking at. As I previously also said, divergence is a good starting point. Then you can confirm your divergence with the stochastic and the RSI. They usually go hand in hand. Few people use MACDs. I mean, again, how many indicators you're going to use? How many confirmations you're going to get? The more indicators you use, the more confusing you're going to get. Here I show you a chart of how my chart looks like. This is my chart. You know what I mean? There is no indicators.
Yeah.
I got support, resistance, and trend lines. I don't use any indicators whatsoever. I don't need to confirm because I know support, resistance lines, if they're drawn in the proper places, they work. Here, look. This is the whole history of support, resistance lines on Euro USD. One way or another, they'll get there to some point, and I know what to expect. I know where the price is going to go next. And they keep on hitting, those points here, support, resistance. Again, support, resistance. I know where each time, if it breaks through each line, where the next take profit is going to be. I know which level. I know what to expect. I don't need indicators to tell me. Yes, I can put on the stochastic for that matter or on RSI, but when you know how to read the chart.
I see Fibonacci.
Sorry?
You use Fibonacci to help?
You can use Fibonacci, exactly. Fibonacci, I suppose, works in the same principle as support resistance lines because that's, at the end of the day, that's what they are. But Fibonacci will not show you every support and resistance lines. Okay. You'll jump some, and sometimes, let's just say, all right, I'll give you an example here. Excuse me. Let's do one. I might have to move back a touch. Find something corresponding. Has been a long trend. Maybe you'll do it daily. Okay, let's assume. So that's the top in here, and let's assume that this is the bottom. So there we go. With the Fibonacci, where is the bottom? I think it's somewhere here. If you're going to enter this, obviously you're thinking that, okay, if this goes up, it's going to go up to the 23.6 at first. That's quite a bit of a hike. But if you're using different support and resistance lines, I mean, this might match the 23.6 in here. The 38.2, I wouldn't say it really matches. There should be another one in here, going across in here. This one's probably okay. I would probably put another one in here. There should be another one in here. Because prices, just like in here, a good example, you might think, okay, bouncing off here, it's making in here, it's breakthrough in here, and you could let's just say, jump into this trade in here thinking, well, now it's going to go towards 50, and what happens? You get the next buy and it turns back down.
Went down. Yeah.
Okay, so you would have jumped in too late.
If you have a look at the stochastic, it was in an overbought situation.
Stochastic, that's what I mean. Stochastic can actually help you saying, okay, we are on the top, we are turning down, so maybe entry to the upside, it's not really good. But really, see, if you wanted to confirm with the RSI is saying, hang on, I'm about to break through the 50, therefore I'm a buy. You know what I mean? So you would have to actually wait for the confirmation for it to break, which it didn't. Then it turned down, and then the stochastic also turned down, but that was at this bar here. A lot of people having seen this bar here closing above, they would probably jump into on this bar, or even thinking, okay, this bar closed above, now the next one went even higher above, okay, it's going to continue. So you'll jump into here, not looking at, let's just say, those two now, and you're gone. You'll make the wrong move, just boom, straight away. That's why Fibonacci does work to some level, but I prefer to use support and resistance lines. I've also put up the videos about the Fibonacci on the YouTube channel, FXTG Australia YouTube channel, so you guys can look at it if you haven't seen it yet. And I sort of explain more about it.
How do we search it, under Lucjan or FXTG?
It's FXTG Australia.
Okay.
You should see now there's 3 videos. I know there's another channel of FXTG. It's got some older videos, but look for the FXTG Australia, and you'll see actually on the videos on the front cover, you actually see the very first page that this begins with. Actually, it's got my name on it. This is all the new videos that I'm making. I'm recording this as we speak. So at this point, like I've been saying, I'm just trying to build up a bit of knowledge for you guys about different indicators, different ways of putting something together and understanding them. And then we're going to get more into the nitty-gritty of actually trading and looking at setups maybe and entering the market or exiting the market. You know, not everyone likes to use the same indicator, so I'm trying to cover as many indicators as I can so everyone can, you know, get to maybe learn more about something that they use themselves. Is there any other questions?
No, I'm good.
Marcelo, Gino? Okay. Well, looks like we're going to have a short one today. Just trying to think whether there's anything else in here. Any question about the indicators, how you can change values? Oh yeah, there we go. There's another thing. Obviously, you can change values. If you right-click on your chart, you go your indicators list, stochastic, you know, 533. Depending on the time frames, if you want to see a little bit differently, you can actually play around with those figures. They are just default figures. Yes, a lot of people use the default figures, but then again, some people actually play around. So if you were to change the K period, you'll get the indicator to look a little bit more different. And then you can sort of check out whether the peaks, more peaks maybe will suit a little bit better. Like see now, where the bottom is in here, before it went up to here, which could have got you out of this trade early. But as you can see here, you would have stayed in because the stochastic never crossed it, and neither did the RSI. So it's good to actually play around with the settings. I never used the default settings. So as you can see here, it would have been a perfect example that you would have entered the trade right above here where this crossed here, and you wouldn't have gone out of this trade anywhere when this moved up, because this confirms actually with the RSI more that is actually in the exact sync of it, and then you would have got out basically somewhere along here. So do play around with the with the settings, usually with the first number, same with the RSI, indicator, RSI, look for inputs and just change the value, you know, to whatever, 21. Try to use the Fibonacci numbers, usually the best. 3, 5, 8, 13, 21, 34, 55 and 89 and so forth. So play around with them, see what looks more smoother, more better, that actually corresponds with your entry and exit points. Okay, so it's definitely worth a look in changing the values on your indicators. 'Cause each time you change it, and just look back in the history and see how it's corresponding with, because there's no point of just looking at one day. Look in the history, how is the indicator, you know, responding to every change.
Yeah.
Well, that makes more sense. You know, here now it's definitely showing, you know, diversions in here. Now you don't have to use that one. Or you could have even in here. So what you would have got in here, you get a good, not a really tight stop loss, even though you would have got in here, would have went, and then it's still turned around anyway if you were to do a divergence on this. Or maybe you could have got yourself out when the stochastic turned. Or maybe you wouldn't have even gone into the trade from this one because the RSI is still sitting up the top. You know what I mean? So use at least one or possibly two indicators to confirm if you're going to use indicators for trading. So, you know, you can use that Fibonacci, you can use the stochastic, you can use the RSI, and that's basically a system in its own to be used. Again, it's for everyone's got their different likings. Like I've shown you before, I tend to go for, you know, charts that, you know, look like this. There's no indicators. All I've got is support, resistance, and trend lines. Support, resistance are the yellows, and the trend lines are all the reds. So this is how I trade. You know, it's basically like a naked chart. This was an example. I don't actually use the moving average. Again, as you can see, trend lines and support, resistance. This is how I trade it. Basically, like a naked chart. So that's about it, guys. If you guys got any more questions, I can try to answer it before we finish off.
When are you going to post this on YouTube? Next week?
This should be posted on YouTube. I'll try to do it tomorrow. Okay. So it should be up tomorrow morning because I've got to convert this video and then post that up. So let's just say by lunchtime tomorrow, this should be up on the YouTube.
YouTube Australia.
FXTG Australia.
Excellent. Thanks, Lucjan.
All right. All right, guys. Thank you for attending. And I hope to see you guys next Thursday. If you got any ideas, feel free to email me, and I'll look into the ideas and see what I can do a live webinar again based on your recommendations.
Thank you very much.
No problem. Thank you again, and goodbye.